Good morning, everybody. It's Ed Yardeni. Thank you for joining me, and Eric's joining me as well. So today is June 10th, Monday, June 10th. I hope you all had a good weekend, and I hope we all have a good week. We think there's no particular reason to believe we're going to have any major problems in the markets. Last week's big surprises occurred on Thursday and Friday. On Thursday, the big surprise to us was unit labor costs. So we were expecting to see that on a year-over-year basis, unit labor costs had been revised upwards. That's because real GDP was revised downwards during the first quarter, and that in turn implied that productivity would be weaker, which it was. But the big surprise was actually in the fourth quarter. In the fourth quarter, we saw that unit labor costs were revised dramatically lower. And so when you take the year-over-year percent change in unit labor costs, it was only up 0.9%. And as we showed in the chart, and we've shown this chart several times to you, if you take the year-over-year percent change in unit labor costs, by the way, are hourly compensation divided by productivity. So when you are looking at what sort of wage pressures there are in the labor market, you want to look not just at wages, but also the extent to which wages are justified and are being offset by productivity. So again, unit labor costs we view as the core underlying inflation rate. And there's a very close correlation between unit labor cost inflation on a year-over-year basis and the CPI inflation or the consumption deflated inflation on a year-over-year basis. The unit labor costs are available quarterly, and they tend to be actually a little less volatile than the price indicators. So it's not a one-to-one correlation, but it's a pretty good one. And certainly from a theoretical perspective, it makes a lot of sense that since labor costs account for the bulk of producing things in the United States, both in goods and in the services, that unit labor costs would be so important. So that's really keeping us pretty much on the confident side that we're heading towards the Fed's 2% inflation target by the end of the year. I mean, we're already at 0.9% year over year in unit labor costs. That should put a lot of downward pressure on inflationary pressures. The other surprise, of course, was on Friday when we had employment turn out to be better than expected. Actually, you could get whatever you wanted out of Friday's numbers. If you're an optimist, you looked at the payroll employment numbers, which were very strong. If you're a pessimist and think the economy is not doing very well and are taking that perspective, then we had the household employment data, which was actually down somewhat. And there has been this divergence between the two where the payroll numbers have looked much better than the household numbers. So, you know, I haven't, I don't know if Eric, if this is rubbed off on Eric yet, but my attitude towards these numbers is pick the one that supports your story and look at the other one as somehow being wrong. I know some people have been looking at the birth-death model, and Eric's doing some work on that. But all in all, we find that the payroll data is probably relatively a better indicator of what's going on in the labor market than the household data. I mean, the household data, you have a government worker calling you up, and I don't know how they're calling up cell phones, but in the old days, they used to just kind of randomly call phone numbers and say, "Hi, I'm from the government, and I'm here not to help you, but just to ask you what your employment situation is." I would imagine that over the years, people have gotten a little bit more circumspect about talking to anybody over the telephone. I know that I regularly hang up on the calls because of the robocalls, but sometimes I miss important calls as a result of that. But I think people are a little bit more leery about answering surveys, especially about your employment, your wage, and things like that. On the other hand, the payroll data is derived from surveys of employers, and there too, the government's having some issue with getting responses back. But I think at least they're getting responses that more accurately reflect what's going on. And then, to really get confused, you could always look at the ADP payroll data, and that's been way off. There was a time before they recalculated their numbers and rejiggered how they do it, where the numbers were actually pretty close to the non-farm payroll data. Now that's not the case anymore. So you have to sort of take your pick. And one of the reasons we pick payroll employment is because that's how the government, in fact, decides what wages are doing, wages and salaries are doing in personal income. They take payroll employment, they multiply that by the work week, they multiply that by average hourly earnings, and that gets you nominal wages and salaries. And we find that nominal wages and salaries, or the proxy we have for that, is called the earned incomes proxy. And the earned incomes proxy, which again is a proxy for private sector wages and salaries and personal income, that's pretty highly correlated with important things like retail sales, which comes from a different survey. So we're finding that that sort of corroborates that the payroll data through the earned income proxy kind of makes sense. It also it correlates with, again, it correlates with wages and salaries. So it correlates with personal income as well. So we'll look at those charts in a minute. But this week is a big one for the Fed. The Fed meets Tuesday and Wednesday. Wednesday, we have Powell's presser. And then that very same morning, just as they're getting set to meet for their second day in a row, they're going to get the CPI. Eric's been doing some work on anticipating what Powell is going to say. If Powell, for some reason, can't make it, Eric's available and could fill in for him quite nicely. Eric, what were some of the thoughts that we were discussing about what, I guess the bottom line is he going to be hawkish or dovish?
Yeah, I mean, they're obviously not going to cut rates. We're expecting Powell to talk a little tough on inflation. I think the Q1 nominal growth data was a little strong. It might have spooked policymakers. And every time the market thinks there's going to be a bunch of cuts this year, that loosens financial conditions. So I'd expect some tough talk. But, the markets will interpret it how they will. We also get the new summary of economic projections, the quarterly release. And we think that could reflect a little, a little more hawkishness as well. If they revise higher their real GDP estimate or their estimate for PCED inflation, that wouldn't be too surprising. It would keep us in that higher for longer regime. And I guess they'll probably forecast maybe just 1 or 2 cuts for the remainder of this year versus 3, which they were looking at in March.
Well, the problem we're all having is we're all getting older. In other words, time marches on, and we're no longer at the beginning of the year thinking about how many rate cuts we're going to have for this year. Increasingly, the year is coming to an end, and we're running out of time in terms of how many rate cuts will fit in this year. And so I think increasingly, at least the way we're looking at it, is how many rate cuts do we get over the next 12 months? Now, just to relay to everyone some of the work we've done on real simply looking at the federal funds rate versus the 12-month futures.
Yeah, so we're seeing like 2 to 3 in the futures market, about 2 to 3 cuts, 25 basis points each over the next 12 months. Again, that was as high as 7 coming into the year. And it's kind of wobbled around that 1 to 3 area. I think fortunately from like a volatility perspective, the non-farm payrolls print on Friday did a lot of that. Oh no, the Fed is going to be more hawkish work for us. So we're at like 1.5 or 2 cuts for the coming 12 months. Again, there's a lot of the street forecasting that September will be the first cut, and strategists just kind of keep pushing back their forecast for when the first cut will be. But we still don't think they should cut, and I don't think they really need to. There's nothing materializing in the labor market data that necessitates one.
Well, Eric, as you know, there are a few fringe people out there that for a while have been saying we should end the Fed. We don't need the Fed. The Fed, all it does is rig the markets. But for you and me, it's good that they exist. It's content, and so it gives us lots to talk about on a regular basis. My advice to Fed officials is take the rest of the year off, enjoy it, have a vacation. But then again, maybe that's not in keeping with what we need. We need to hear what they have to say and how they're tune is changing. And so right now we're still in that we have been in the blackout period, and it's always exciting to hear Powell's press conference, see how that unfolds. But I'm thinking that the SCP, the Summary of Economic Projections, may kind of scoop his press conference that, if it's what was the in the previous SCP, which comes out every quarter. I guess the previous one was March, right? So the
Yeah.
March one, I think, had a Fed funds rate basically at year end at 4.6%,
Mhm.
which again implied three rate cuts. Um, we're thinking maybe they'll show what, something like five
Yeah,
percent,
nine or
and
five. Yeah.
yeah, I mean, if they show 5%, I think that would kind of indicate that the whole committee is turned, slightly more dovish. Let's do that again, slightly more hawkish. Anyways, why don't we have a look, share the screen here with the folks, and have a look at the charts from the chart collection today. So this is June 10th, Monday morning. And so our focus this morning is on the employment numbers, kind of showing you some of the charts that in fact support the story I told at the beginning of our call here. So the labor force and employment measures, you can see that the payroll numbers have been increasing. They've been going up into record high territory. So is the household survey data, but it's looking kind of toppy here. So again, if you want to be a pessimist, you say, well, this is closer to reality. You can see that the household data tends to be consistent. Actually, that tends to be it is higher than the payroll data. It includes self-employed people, and so that's part of the difference. This other number up here was the labor force. Labor force is still expanding. It also tends to be somewhat volatile on a month-to-month basis, but we're clearly seeing that as people see more, have seen more job opportunities, they've entered the labor markets, and to a large extent, they've been employed because the unemployment rate has been at 4% or less now for 30 months. So that's a pretty impressive stretch. We'll see that in a minute. This is, by the way, just a fun chart showing, okay, so let's take a look at payroll employment divided by household employment. And again, you can see that right since the beginning of the data, payroll employment has been lower as a percentage of household employment. But you can also see there's been kind of a puzzling upward trend here. I don't know, is that fewer people are participating in these household surveys? Is it maybe there are fewer self-employed? I was under the impression that more people were working for themselves, but maybe what they're doing is they're setting up a company, and when you set up a company and get paid through a company, you're not really working for yourself. I know that I used to be able to kind of call the local plumber, and he'd come right over, or as soon as he could. Now, when I call the local plumber, I'm talking to a company with receptionists and schedulers, and they have a whole bunch of trucks, and all these plumbers are now working for this company. Doctors, the same story. Doctors used to be basically self-employed in their own limited company, little limited corporate entity, so they wouldn't be too liable for creating any problems with their patients. But now all these doctors are working for major corporations, so whatever it is, it's something to factor in that this has been going on for a while. But going back to payroll employment, so here's the average weekly hours that are worked, and that was flat, and you can see it's been zigzagging without any trend here. You can also see that when we take that zigzag of average hours worked and multiply it by payroll employment, which was that number over here, we get aggregate hours worked on a weekly basis. So this is in billions. Well, actually, I think we converted this to monthly data. So it's 4.6 billion hours is how much all of us working stiffs put in to make a living. And you can see that's been zigzagging along with that average weekly hours, but it's been zigzagging along, rising, not going sideways, rising in record high territory. And now aggregate hours worked are at a record high. You don't typically, you're not in a recession when this is going up. And I know there's a few folks out there that actually think we're actually in a recession now, but you're definitely in a recession when you see aggregate hours worked going down because the work week's going down and because people are losing their jobs on that balance. So we calculate our earned incomes proxy. That's this number over here. And we do that by taking non-farm payroll employment and we multiply that by average weekly hours. And then let's see, by average weekly hours and then by average hourly earnings. So you can see that that is actually, from what I gather, this is actually the way that the Commerce Department, the Bureau of Labor Statistics, comes up with their estimates for wages and salaries in personal income. So this just rose, I think it rose 0.6%, if I'm not, yeah, it was 0.4% for the average hourly earnings on a month over month basis. And it was an increase of 0.2% in payrolls and zero for the work week. So you can see that that's at an all-time record high, and that implies that wages and salaries and personal income will be at an all-time record high. And you can see here that how much wages and salaries, private wages and salaries and personal income accounts for personal income. It's basically around 44%. There's obviously the government provides some income through entitlement programs. There's interest income, there's dividend income, there's all kinds of other sources of income. But this is the one that tends to be most highly correlated with things like personal income and like wages and salaries. And this is a very colorful chart for sure. And within that, you can see the earned income proxy is in there in blue. And then you can see how it correlates well with various measures of income, private wages and salaries, retail sales with food services, without food services. It's the basic driver of consumption. Certainly has a significant impact on it. This is kind of looking a little bit without all that noise and just looking at the earned income proxy, this time in red, and comparing it to retail sales ex food services and with food services. And the bottom line is we should have a relatively good, strong retail sales number report in a couple of weeks when that comes out. And personal income, when it comes out at the end of the month, should also be pretty strong. So the payroll data, I think, sets the stage for a month of better than expected economic indicators, in which case the Citigroup Economic Surprise Index might surprise us to the upside after surprising us to the downside of late. And if that's the case, the bond yield, which I guess dropped to 4.28%, didn't get down to 4.25%, didn't touch that level when the payroll numbers came out. It blew out by about 10, 15 basis points pretty quickly to the upside. So we're basically, I guess, at a little under 4.5% on the 10-year. And we think that's an attractive rate relative to our inflation outlook. And we think it's a normal rate. We've normalized interest rates. I mentioned that retail sales should be strong, and we're looking for confirmation of that in the retail employment data. And that was up, as you can see. And so retail sales look like they're continuing to do better. And that's even though the goods economy's been kind of going sideways. So retailers are still expanding employment, which is kind of interesting. This is another indicator we get when the employment number comes out. We get manufacturing aggregate weekly hours. The reason we're focusing on that is, again, we're trying to get some handle on what the numbers are going to look like this month for the economy, and we think on balance they look pretty good. The manufacturing aggregate weekly hours increased 0.5%, so that's that number, and this is manufacturing production. So industrial production should be a solid number, but we're still kind of in a funk here. I mean, while retail sales employment suggests that selling merchandise is still going well, the overall production, maybe we're importing more from China. And by the way, that's why inflation has come down on the good side. So again, let's look at slice and dices of employment by selected industries. This is monthly change. This is in year-to-date change. And you can look at it on your own, but the basic point is that we're pretty comfortable with what we're seeing here. That all looks kind of consistent with our view of the economy that baby boomers are retiring, and guess what? They're spending a lot more on services. They're spending more on healthcare and social assistance. So that was a big contributor to the monthly increase in payrolls. We've got a lot of, some people call it illegal immigration, other people call it a lot of newcomers, whatever you want to call them. The government is probably in the position, especially local governments, as you can see, local governments have accounted for a lot of the increase. Maybe they're hiring school teachers. There's more kids that are being enrolled in schools, and there's also more need for social assistance. So that may be some of the explanation for why the government is so strong. Leisure and hospitality, the baby boomers are going out to eat. The baby boomers are traveling. They're not the only ones doing that. I was just recently went to Kansas City, and my flight was, I had one direct flight and two connecting flights coming back. They were all completely full. The airports were absolutely mobbed. And I'd say I was looking for people like myself with gray hair, baby boomers. And my informal off the cuff survey is something like 50% of the people in the airport were baby boomers, silver haired, and everybody else was all the others. But anyway, you look at it, it was absolutely mobbed. By the way, Kansas City's got a new airport. They built it about 2 years ago. And you got to walk through it really quickly. Otherwise, you're going to stop at one of these barbecue joints and get totally stuffed with pulled pork, which is exactly what I did. And I didn't feel too good that evening. Anyways, so again, take a look at the year-to-date employment by selected industries, and it's pretty much the same pattern as we see on a monthly basis. So all that kind of makes sense to us. There's a bunch of charts here looking at the wage inflation. This is average hourly earnings that came out with employment. And you can see that wage inflation is fairly well correlated with quits. It kind of makes sense. People quit to get higher pay. If they're kind of satisfied with their pay, if they're satisfied with their work, they're not as likely to quit. If they're quitting less, that's good for productivity. It reduces your unit labor costs because productivity isn't getting hurt by people leaving and having to retrain people. So we continue to see a downward trend in quits. We don't view that as a sign that there's something wrong with the labor market. Quite the opposite. We just kind of view it as kind of normalizing. You can see that the quits rate is kind of where it was before the pandemic. And so that's helping to bring wage inflation down, which is a good thing. But, Powell has said that he'd like to see wage inflation down to 3%. Right now, it's running more like 4%, but it's certainly heading in the right direction. So you can look at these other charts on your own. There's there are these other measures of wages, like wages and salaries and employment cost index. They're all telling the same story. It's just we're still kind of around 4% rather than 3.8%. This is unit labor costs. This is a favorite chart of ours. This shows unit labor costs, and again, it was revised down to 0.9% on a year-over-year basis for the quarterly data. And we think that it kind of determines the underlying inflation rate and does kind of conform with our view that there's still more downside for headline PCED. By the way, we looked at wages for all workers, which is this one, the red, and for lower wage workers, and then for higher wage workers. And this is what's called production and non-supervisory workers. So we had that, and then it was pretty easy to calculate higher wage workers. And you can see this is what they get paid per hour. So it's higher wages, so they're up here. But you can see that adjusted for inflation, higher wage workers actually are still down. They've actually seen a reduction in their purchasing power and their standard of living, if you will. If purchasing power determines what you can buy, what you can buy determines the standard of living, at least the way conventionally measured. And then you can see that the lower wage workers actually came out somewhat ahead in real terms. So this idea that lower wage workers have been taking it more on the chin than anybody else, and we've got this kind of two-stage economy where some are doing well and others aren't doing so well. There's something to that, of course. I mean, certainly this wage is a lot higher than this one, but in terms of the impact of inflation, the lower income workers have actually done better than higher wage workers. But then the higher wage workers have more wealth, they have more other sources of income. But I did want to point that out as sort of a way to balance things off relative to what people have been saying. This is just, the argument about whether the labor market is solid or not. What we find that initial unemployment claims and things like jobs plentiful, job openings, these are all indicators that suggest that things are normalizing. We don't think this means that things are getting worse. We think things are just normalizing, and there's just still plenty of job openings and still jobs plentiful according to some of the surveys. So the bottom line of it, all of it, is maybe we're at where we should be. Maybe the interest rates are appropriate for what the economy is performing. I mean, the dual mandate is being satisfied here. The Fed's mandate is to keep inflation down. Well, it's been at 4% or lower for quite some time. Even before the pandemic, it was down below that. And meanwhile, inflation seems to be coming down in the right direction. So why mess with success? Eric, anything you wanted to add to my monologue there before we do a little Q&A?
I guess something on the household survey, which is the quote unquote negative side of it. A lot of the decline was actually in workers ages 16 to 24, which is interesting. And this time around, the household survey captured like the end of school. So you might have gotten an uptick from basically teenagers in high school and college
Mhm.
looking for work. And when you look at prime age labor force participation, so 25 to 54, it actually hit a new high. So even within the bad side, things didn't look as poorly as some might have
Yeah,
made
Eric,
them look.
Eric, I think you're a little bit older than 16 to 24, but maybe you know those people better than I do. But actually, I have a couple of kids that are still in that bracket. Actually, they're 20 to 24. But do 16 to 24s pick up their cell phone to talk to a government employee when they
I
got
don't think they pick up their cell phone at all.
yeah, I mean, they say, it says the government. I mean, I don't know if they pick it up. Anyways, let me put on my other glasses here and see what we got going here. I hope I'm pronouncing this right, Saud. With the introduction and application of AI, should we expect unit labor costs to continue to decline going forward over the next couple of years, which in turn should put a lid on inflation and support equity markets? Yeah, you can come work for us. That's been our pitch that we're in the roaring 2020s and there's labor shortages and companies are going to use technology to increase the productivity of their workers to augment the productivity of their workers. They're not going to get rid of workers. They need everybody they can get. They just need them to be more productive and more skilled, and technology can help them do that. And I personally have expressed some skepticism about the immediate positive impact of AI and productivity. I think if AI is used within databases that are self-contained and are corporate and aren't polluted with open source, picking up whatever's in the internet, I think that can be very important. And to me, AI, when it's used that way, can basically is fast computing. I mean, Elon Musk has basically come to the conclusion that if he glues a lot of these GPU chips together, he could get himself a supercomputer. So maybe we don't need quantum computing. Maybe we're going to find that you string enough GPUs together and you get a machine that's fast as can be in terms of computing, and that's where you see the productivity. Lucas, hi guys. What about the unemployment rate going finally to 4%? Is that something that tells us the direction of a weaker job market? Eric and I were talking about that, and I was saying that, my God, if we get to 4.1% on the unemployment rate, is everybody going to freak out that the labor market is collapsing? No, I mean, there was, Eric, wasn't there some talk that the Fed, well, I mean, what's the Fed's SEP on the unemployment rate, the Summary of Economic Projections?
They have four this year and then like 4.1 in the next couple of years.
Yeah, and there was some talk that maybe they wanted it a little bit higher than that in order to bring inflation down. But this old-fashioned Phillips curve model of the inverse relationship between unemployment and inflation isn't working too well. And maybe it's because it doesn't incorporate an important variable like productivity, and maybe it doesn't. It's too domestic. It doesn't look at the global economy. The fact that some of our disinflation, if not our deflation, is we're importing from abroad from China, which is desperately trying to offset their property bubble by dumping goods in global markets. Let's see here. Oh, there's a follow-up from Saud. Just to follow up on the AI application on the global economy, I believe I saw an article in the FT by the deputy managing director of the IMF saying that AI could lead the next downturn in the global economy as 30% of the labor force will be at risk. What are your thoughts on that? My thoughts are, it sounds like Luddite thinking, the idea that technology is going to replace jobs or make people more vulnerable to losing their jobs because in a downturn, AI can do everybody's job. That's I'm not in that camp. I think technology is going, as I said, is going to augment the the skills, the productivity of workers. That makes them more valuable. That gets them paid more in real wages, and more real wages means they can go out there and consume. So it all kind of fits nicely together. Steve Shapiro, can the explanation for the current 12-month forward multiple be that the market sees unit labor costs declining, productivity rising? Yeah, I mean, the 12-month forward PE um, is is a tough variable to forecast. Uh, but to the extent that anybody tries to forecast it, we usually put in our models something about interest rates, something about inflation rates, and it's pretty remarkable to see a forward PE of over 20.8 with interest rates where they are. But then again, we know that the Magnificent Seven, we like to add Netflix in there because I like movies, but the Mega Cap 8, those stocks are almost at a 30 forward PE. So, but yeah, I mean, if the market's in our camp thinking that inflation is going to come down to 2% and stay there for quite some time, then that may very well justify a higher PE, or at least this PE. I don't know that I want to push my luck here and see this PE go a lot higher. Finally, Ian, if banks are making less net income and consumers are making substantially more interest income, which they are spending, what impact do you foresee to spending once the Fed lowers rates, which means less passive income to boomers? Well, I got good news. Uh, we're not really expecting the Fed to have to lower interest rates all that much. We're again in the camp that the empirical camp, the economy is doing pretty well. It's been remarkably resilient with this level of interest rates for all sorts of reasons. The big picture view, which I've recently been promoting, is that many years ago we had the agricultural revolution, then the industrial revolution, and now the digital revolution. And the digital revolution may mean more productivity. May mean that the economy can withstand higher interest rates. It's got no problems with it, partly because the digital economy generates a lot of cash and doesn't necessarily need to borrow and doesn't have high interest costs. But to answer your question, if interest rates take a big dive, that would probably be consistent with a weaker economy than we're looking at, and we'll have to look at it when that happens. As they say in courts, I don't like to answer hypothetical questions. I guess I'm supposed to, right, Eric? That's what we do all the time. Anyways, Eric, thanks for joining me, and we both wish you a good week ahead. Thank you. Oh, by the way, one last thing. My son David Yardeni is working for us now, and he's done a crackerjack job of creating personalized chart books for our clients. So if you like our charts, but you're having troubles finding where they are, we can create a chart book that has your favorites all in one place. So take a look at that. Send us an email, and David will help you out on that. Thanks again.